In January 2025, Dubai property prices dipped by 0.5%. That might not sound like much, but it's the first monthly drop in nearly 2 years. And for serious investors, it's raised the question, are we still in an off-plan boom, or is this the start of a bubble? Now, just so you know, I help clients build property portfolios, but I'm not here to pitch you, because Dubai's off-plan is not for everybody. So what I'm going to do is walk you through the real numbers, the real risks, and what's actually happening in the Dubai off-plan property market right now, so that by the end of this, you'll have what you need to draw your own conclusion and work out whether it does make sense for you to invest or not. So to really understand if Dubai off-plan is still worth investing in, you need to understand what's happening in the market currently. And right now, it's a lot like a gym membership. In January, everyone signs up thinking they're going to get ripped in just a couple of months. They're pumped up and they're expecting rapid results with minimum effort. And to be fair, between 2020 and 2024, the Dubai property market was exactly like those first few weeks in the gym. You didn't have to be a pro or have the perfect plan. Almost everything you bought went up, with property prices nearly jumping 70% in 4 years. But now in 2025, we're past the January rush. The market has started to stabilize, and the quick, easy gains, they're not really there anymore. Prices are still growing. Villas are up around 20%, apartments nearly 19.5% year on year, but the momentum has slowed. And in January, we saw that first slight drop in almost 2 years, only 0.57%, but it's a sign that things are shifting. Now, I've had people still coming to me saying they want to double or triple their money in 2 or 3 years. And to be honest, there are brokers out there who'll tell them exactly what they want to hear. But those expectations aren't based on a version of the market that doesn't really exist anymore. The reality now is if you want the results, you need a clear plan. Just like going to the gym, after the initial hype fades, it takes consistency, patience, and a bit more strategy to get the results you want. You need to understand what's changed and where the risks are starting to appear. And that's exactly what we're going to look at over the next few points. So the first thing we need to consider is the supply and demand, because while demand is still high and we know the population is growing, supply has picked up significantly in some parts of the city. Developers are still launching at a pace, and in a few areas we're starting to see that show up in the numbers. A good example of this is Shoba Heartland's Riverside Crescent. Now, I'll be honest, I really like the developer. I'm very fond of Shoba products and I've sold many of them. Shoba builds to a very high standard. But if you look at this particular project, you'll see a large cluster of buildings, all quite similar in design, all launching at once. You've got hundreds of units per building across, I think, around 16 towers. So what happens when they all hand over? Everyone becomes a landlord at the same time, and you suddenly have a flood of similar units hitting the rental market and competing for the same tenant pool, all listed roughly at the same price. It becomes harder to rent and harder to exit. Now, if you did buy into this Shoba project, the lagoon-facing units are the premium ones, and in my opinion, in that case, you've made a very successful investment. So oversupply is a risk in 2025, and that's why we've been having an honest conversation with our clients about how they're positioning their properties. If you're going to invest in a high-supply area, your unit needs to stand out, whether that's the views, the floor height, or even the way you present and furnish it, and of course, the developer. We've had clients spend a bit more time on the styling. We've helped them do the feature walls, proper furniture, better designs, and guess what happens? Their units rent out first. It's those little details that make the difference when tenants have hundreds of options to choose from. So if you want to invest in 2025, it's not enough to just own any property in a good development. You have to think about how your unit is going to compare against the others, because you need to stay ahead of the curve. Otherwise, you'll be chasing the rest of the market. By the way, if you want to be updated when those type of off-plan properties come up on the market, you can sign up to our free WhatsApp group using the link in the description, where we share profitable off-plan deals that we have pre-vetted, as well as any tips on how investors like yourself can invest in Dubai. The next thing we need to consider is tax and regulation. Now, Dubai is still one of the most tax-efficient places to invest in the world. That hasn't changed. But what has changed is how the system works and what you need to be aware of before you invest. The big one, of course, is the new corporation tax of 9%. Now, I'll be honest, this hasn't impacted most of our clients yet, especially those buying a couple of units. In a lot of cases, you can still buy under your personal name and avoid triggering that tax altogether. There's no set number of properties that pushes you into that corporate structure necessarily. It's more about the scale and how the activity is classified. But if you are planning to build a serious portfolio, it's something you need to think about and think about early. The other change is how banks are approaching fees. Until recently, many of the banks here covered things like the 4% DLD and the 2% agency commission. That, of course, made the upfront costs of buying a property a lot easier to manage for most people. But now, most banks have pulled back on that. Those costs are coming straight out of your pocket if you are buying a ready property. So that's an extra 6% of capital that you need to factor in on top of the deposit and the mortgage costs. And it's not the end of the world, and it's one of those things that people forget when they're about to run the numbers. And lastly, something a lot of the UK-based investors forget is the landlord-tenant laws here in Dubai are very different for the best though. We've had people come to us from the UK saying they're fed up with the tenants who don't pay, dragging things through courts and sitting in properties for free, not paying any rent. But you see in Dubai, that's a criminal offence. And people take that seriously. So from a legal protection standpoint, Dubai is still one of the most landlord-friendly places to invest for sure. But you need to weigh that up against the rising costs and the new tax framework, especially if you're planning to invest in scale. And again, this all comes back to knowing what you're buying and why. Because your returns don't depend on the property, they depend on the structure, the costs, and how you plan to grow over time. Now, let me ask you something. Would you rather buy a property that promises 15% returns only to realize later that you're barely breaking even, or go for a solid, reliable 6 to 7% yield, knowing exactly what you're going to get every single month? It sounds obvious when I put it like that, right? But here is why I ask. I've had clients come to me after getting sold the dream of 12, 15, or even 20% yields. And when we actually break down the numbers based on the current market evidence, after factoring in the service charges, potential void periods, realistic rents, it's nothing like what they were pitched. And that's the reality of 2025. People miss selling you dreams. You see, a couple of years ago, you might have been able to ride the wave and hit those double-digit returns without trying too hard, but the market's matured now and returns have normalized, which I think is a great thing, by the way. And what we're seeing now consistently is around 6 to 7% net yield. And when you combine that with the capital appreciation, it's still a very strong investment, especially when you compare it to what a lot of UK landlords are used to. I've had multiple clients tell me they're lucky to get 3 to 5% back home, and that's before the tax, the maintenance, the headaches, and the tenant issues. So when they come here and see they could be earning 60, 100, 200,000 dirhams per year, sometimes more, from a single well-positioned property, feels like a massive upgrade, right? But again, not every property is going to deliver that. It comes down to the deal, it comes down to the price you buy at, product you buy, and the reliability, and even things like service charges and location. So when someone asks, what return can I expect to invest when I purchase in 2025? My answer is always, it depends on what you buy and how you buy it, because the market still performs, but only if you get the fundamentals right. Now, the final thing we need to consider is this. How easy is it to actually exit a Dubai investment in 2025? I get a lot of questions. Well, Dubai's property market is still very active. There are hundreds of transactions happening every single day, and both buyers and sellers, local and international, are very much still out there, but only the right properties are selling easily. We've seen sellers who overprice them based on emotion or old hype, and then they wonder why the property's been sat there for months with no offers. We've seen that a lot. In a more mature market, like this one, realistic pricing and product quality matters more than ever. Now, if you are a foreign investor, say from the UK, the exit process is actually very straightforward. For our clients, when it's time, we handle everything from listing the property, managing the viewings, negotiating with the buyers, completing all the paperwork through the Dubai Rest app. Once the deal is agreed, our legal team secures all the necessary documents, including the NOC from the developer. And in most cases, when you sell a property, the transaction can be wrapped up to 6 to 8 weeks for a mortgage purchase, or even faster with cash deals, as fast as a week. Everything happens at the trustee office, buyer and seller meet, fees get paid, keys get exchanged, title deeds get given, and the deal is done. So yes, exiting is still very doable in 2025, but how quickly and profitably the exit is depends entirely on the market and what decisions you made up front. And that's why everything we spoke about earlier all links back to this moment, because whether you're holding long term or planning to sell, your strategy needs to start with the end in mind. So in summary, is Dubai a good place to invest? Well, for me, I'd define a good investment market as one with strong demand, good returns, decent tax laws and legislation. And although the Dubai market might not be the same as it was 3 or 4 years ago, I would say it still ticks all of these boxes. But Dubai isn't for everybody. If you're chasing low budget, short-term flips and expecting 20% returns in 6 months, Dubai not might be the place for you. But if you are looking for high quality and high budget properties and your expectations are realistic with the yields, Dubai still offers a lot of value and off-plan can be a great option. And if you are the type of investor wanting to invest in off-plan and have a budget of at least 1.5 million dirhams, you can use the link in the description to book a call and we can talk about the off-plan market and what deals we have available. However, if you want to find your own deals, I strongly advise you triple check your numbers, because a lot of people massively underestimate what it actually costs to buy a property here in Dubai in 2025. So check out this next video where I break down the full costs of buying a property in Dubai in 2025.